In this video, I'm going to talk about strategies that are used to keep your money safe. And you probably have insurance on your home or a variety of types of insurance that you're paying for. And while it's no fun to pay for insurance, boy, it sure is super important when there's a crisis or something happens and you need that insurance. Insurance helps us sleep better at night. It really safeguards your financial assets and your home, as well as other areas of your life. It protects you from liability. So insurance is super important. And I want you to think about, with your investing and your investment accounts, are you using any type of insurance? And so sometimes in the investing world that's called hedging, and that sounds really, complex, but hedging really is used across the board with different large financial institutions, and it's also used with large companies that are global. You better believe they're always hedging currencies so that they can try to stay profitable. And so even though it sounds super sophisticated, there's some really complex ways to hedge, absolutely, which I couldn't even begin to explain. But there's some simple sort of safety or hedging techniques that people use that are certainly used by financial advisors. And if you work with a financial advisor, you probably have some of these things in place, but it's unlikely that hedging is a discussion that you're having with your advisor. It's usually referred to as something else, maybe capital preservation, which is a term that's used just saying that your money's going to be there. Your capital, which is your money, is preserved. So the financial lingo is capital preservation, but that just means your money's there when you want it, or even when you don't want it, it's just there. So some of the things that are used or ways to keep your money safe that are types of hedges are, one example that I'll give you is simply one strategy I'll give you is simply increasing the amount of money that you have in cash as markets become more and more overvalued. For example, if you're in your 5, 6, 7 of a strong bull stock market, then it may make sense as a strategy to increase the amount in cash and take a little and allocate a little bit less to the stock market because it's had this huge run. Now this is a little bit more about a little more active management than just that long-term strategy, that long-term buy and hold based on asset allocation we talked about. And that works as well over time. But I'm just sharing with you some things that are strategies that some financial professionals do, as well as individual investors, to maybe work with their investments a little bit more to try to enhance their returns over time. It's hard to guess the top or bottoms of any market, but sometimes you can sort of ease in or out as you see these long-term cycles change. So one way would be to increase the amount of money you have in cash as markets become inflated, or decrease the amount of money that you have in a market as it has become cheap following a correction. Granted, it's hard to do because there's so much emotion and everyone is saying, I'll never invest in the stock market again. And usually that's when the bargains are there. So that's one strategy I wanted to mention to keep your money safe. Another strategy that I wanted to mention is having multiple streams of income. One example might be a rental property. So if you buy rental property, that income is going to keep rolling in regardless, hopefully. I mean, if it's a good market and the price is right, hopefully that income will keep rolling in even during tough economic times or market crisis. In fact, rental properties can sometimes be a great hedge against bad economic times, simply because more people rent than buy because people lose jobs and they can't get financing on purchasing a home. A lot of people say, yeah, I think we'll rent for another year instead of buying. So rentals can be a great way to hedge against bad economic times and market corrections. Another strategy that's commonly used is options. Most funds use options, even though it's considered a bad word. But most funds buy puts to protect against loss in accounts, that stock funds, as the market becomes more and more inflated. So that's a very, very common strategy that a lot of funds, a lot of professionals use, as well as individual investors. Another type of protection is selling the market short. This is done by usually buying an ETF, an index fund, through an ETF, and that just will move opposite direction of the stock market. I would never suggest you do that without really knowing your stuff, because there's a lot of risk to it. There can be. And or if you work with a financial advisor, though, this might be a strategy that you already have in place. If not directly, some of the funds or managers you're using may be using this strategy. It's quite common. Another less sort of fancy, very common strategy, though, are TIPS bonds. And those are used to hedge against inflation, which is a huge problem for retirees. And inflation just means that your purchasing power decreases over time. And the average for that is about 3% a year. And so that just means that, you know how $100,000 today was worth a lot more 5 years ago, 10, certainly 20 years ago. That's because of inflation. So TIPS bonds are a way to protect against that. Now, again, I'm not suggesting you run out and buy it. I'm suggesting that you may want to, if this interests you, research this more. Or if you work with an advisor, ask questions around this. Learn more about it. So this is food for thought for you for keeping your money safe. Another type of another way that people protect their portfolios is by having gold in their investment account. This is a very, very common strategy. It's used by a lot of financial advisors. It's not fancy. It's just as simple as buying a gold index fund through usually an ETF or buying some gold stocks. And gold tends to hold up during financial crisis. Now, that's not always the case. So, because in the 2008 correction, gold went down. So what the idea, though, is to have some things that are negatively correlated. That means that's the investing lingo for they move in opposite directions. Okay. So that is what protecting your portfolio is all about. Is do you have some things that will move in opposite directions when there's a crisis? And also, do you have, if your income is affected, do you have some ways that you'll be safe so that you have income as well? So it's about income, and it's also about, more so, I'm addressing strategies to protect your investment capital that are often used. And again, I'm certainly not suggesting you run out and short the stock market. It might be conversation that you have or research that you do. But these strategies, I want to mention them because they're used by affluent, wealthy investors. And I think it's wise to look to people that have been successful and say, what are they doing? And I wonder if this is something I should learn about as well. So that's what I wanted to share with you in this video.